The most pathetic bounce of bounces. It's Thursday, December 19th, 2024. This is Overtime. I'm your host, Chris Vecchio in New York. Ilya Spivak in San Francisco. Dylan Radigan's off today. He'll rejoin us next week, I think. But we're getting to the holidays, so our schedule is going to be interesting here moving forward. In any event, if you're joining us on the platform, come over to YouTube. Tell us what you're trading. If you're already on YouTube, come join us on tastylive.com. See what we're all about. Today, this market was not about that rally. We had a strong market overnight going into the early U.S. hours. GDP for last quarter is quite strong. We hear incoming Trump officials say they want to bring growth to 3% in the U.S., and that actually means they'd have to bring growth down because the U.S. economy is growing faster than that right now. But the market didn't seem to care. An S&P 500 that traded back to 6,000 in the ESH5 closes the day down near 59.36. That's actually underwater from the close closer to 59.42 from yesterday. So a horrible reversal, a lack of a bounce. As we go to the chart, we see that the NASDAQ here is the big loser, off by 0.55% in today's session. And what was holding out over the course of the day, while the Dow had already lost its uptrend from the August-November swing lows, while the Russell had lost its uptrend, while the S&P had lost its uptrend, the NASDAQ was putting in a fight. But not so more. We are now down below the uptrend from the August and November lows. We closed below the 1-month moving average, treating it as resistance today. There's really not a lot to like right here in the short term if you want to operate on the long delta side, as one of us typically does.
Yeah. No, this is not happy thoughts here. The markets, I was actually kind of hoping that they'd bounce some more. Obviously, I'm short. I've been short. The latest exposure that I have on, just to kind of give folks a sense of kind of where I started to get into this, I started selling Russell 14 days ago. So that'll make it 2 weeks exactly. That's off that double top. I started to layer on SPY shorts 9 days ago. And that was within that range that the S&P held all of December and sort of refused to move on. So that's that congestion right there. And that was just a tactical kind of, this thing is not going anywhere. The NASDAQ is playing catch up all of December. S&P broke to new highs in September. NASDAQ didn't. It finally broke to new highs, finally took out its tops from July rather, in the beginning of December. So it looked like rotation and not progress, because the S&P, which of course subsumes tech and other things also, wasn't going anywhere as the NASDAQ was rallying, which suggested that the NASDAQ was just doing catch up and everything else was lagging. So I got short there basically on the risk reward, just what Tom would call the pot odds, just basically looking at this and going, well, this thing is stuck. The risk reward on the upside versus the downside is pretty good to take a stab. If you're wrong by a little. And so that's worked. But right now we're kind of sitting at support. I think you've penciled it in there exactly right. And I was actually hoping for a little bit more of a pull up to get more short at a better level, because as again, you have here on the chart, the yellow line showing the uptrend from August cooked. So this looks like now the time to start thinking about how to get more short and where opportunities for that arise. And it may not be in the S&P, which has already made its move, but actually in NASDAQ, where you still have a sliver of hope that support might hold. So if we zoom out here just a little bit, we can see where those July highs are, and that's making for something like an area of interest here. This is, of course, the NQH5 contract. In the continuous, it looks a little bit more continuous, for lack of a better term. But that right there is basically what you're looking at. That area. If you can convincingly clear that, let's say overnight here, and you come into tomorrow's session with momentum through that, the way to add short exposure may well be here. Because if this thing escalates and the NASDAQ really rolls over, given its leadership since the start of this rally, now over a year ago, November 2023, you have a situation where things really start to unravel.
It's interesting. A few days ago, on Tuesday, I believe it was, we cited what was the stretch of breadth in the NASDAQ, or rather the S&P 500, having been negative every single day this month so far. And the last time we had seen a stretch that had gone on this long was 1996, and the S&P 500's 1 month return was negative 4.3% thereafter. Granted, it was one of a handful of occurrences that have occurred since 1950 when breadth had been this weak, but the market's return was positive most of the time 1 month later. It sets up an interesting dynamic where maybe we did have a washout type of event that just occurred, right?
Maybe.
It's in line with the historical move, and moreover, something that I couldn't help but notice today, we flagged this before, a number of stocks trading above their 20-day moving average. It's now down at that 8% level, which the last times we were here was back in the middle of April, which was a compelling place to get long. And then again, back in October of last year, which if you got long in October last year, was a pretty compelling place to get long. Maybe this time is different, but we're now in a place where the breadth had weakened so much. We've entered an extreme place of breadth displacement, and certainly the indexes reflect it. So when we talk about pot odds from here, I think about the exposure that I have on right now, which after trading long stocks September, October, November into December, rolling out positions, this stinks. But it also goes to show, and I think the biggest lesson here for people listening in who've been watching this trade unfold, or the trades unfold in long equities over the course of the year, why risk management and trade structure matter so much. Because if these trades were structured as short put spreads or short puts to get that long delta exposure, it would have been a nice little double tap for me, where the expansion of volatility coupled with the downside directional move puts me out of pocket. And when you're trading short put spreads in a low volatility environment, you're really risking one to make, or rather risking 3 or 4, maybe even 5 to make one. You're picking up pennies in front of a steamroller, trying to sell low vol in a low vol environment on the way up. It's why I've been looking at the long call spreads, where even if it's only a 25 or 30% probability of profit, you're risking one to make 3 or 4. And so, even if this trade that I had on in the NASDAQ that gets on here to roll forward towards 23K, if it doesn't work out, it's going to be 41% of the previous winner. So net, I'm not really too concerned about it being a significant loser. I see a reason to hold here for now because I already endured the pain. We're not really closing below the zone of significance just yet, but gosh darn, this is the last place I'd like for it to be. That was we talk about stair step up, elevator down type of environment. When you have a VIX coming in at 13 and starting to creep higher, it begs the question, really, do you really want to be looking to sell vol? And I've always found that answer to be no, and this reaffirms why you structure your trades in a manner where maybe you reach for convexity as opposed to looking to sell the vol itself. But Ilya, the question is volatility, because you have to, we want to discount what happened in August. There's only 2 other times historically where volatility spikes the way it spiked here. When we think about what happened in this market, I think we need to go to the monthly back in August here. Yeah, there we go. Global financial crisis back in 2008, and then COVID in 2010. August is the 3rd highest volatility spike that we've seen. So
I guess in 2015-ish, 2016, you get something kind of big, but not like this.
Let's just mark this off here on the chart, though. In normal times, when we get up to about a 23.5 VIX, it's represented a ceiling. And even back in August, when we had this huge implosion to the upside, or explosions to the upside in VIX, implosion in stock markets, that didn't last more than a week. So if you were in there selling the move in VIX above 25, 24, it was painful for a little while, but ultimately you were rewarded for it. So why is this time different? I guess my question is, why shouldn't we be looking at a chart of the VIX right now and seeing spot VIX up at levels where it's previously crested and not think that this is an opportunity to look to begin to fade the expansion and volatility?
Because it's not an efficient use of capital, in my mind, to look at this and say, well, look at what happened last time. even just from August. It takes 4 weeks, 5 weeks to get back into the range. And sitting on losses in whatever your long risk exposure just seems unnecessary. If you're going to be a trader and you're going to be opportunistic, what this should perhaps tell you is that every other time you've had a breach of this range, you've had at least a few weeks of follow through. And so what you want to look for is that follow through and then change course. So once you convincingly break back into the range and you get a weekly close back into it, even a daily close back into it, okay, maybe I can see that as saying, you know what, let's lighten up on shorts. But let's take a look back at July, August. I mean, you had a much longer down run than anything we've seen so far. Look back even further. Obviously, the sort of extreme cases, COVID, the '08 financial crisis, there was quite a few weeks of pain in there.
Sure.
If you were to go buy right here, you would essentially be saying, in the event that this is anything like the most, let's say, benign versions of this, I'm in for maybe 2-3 weeks of this going the wrong way. Why would I do that? Why wouldn't I at the very least wait
right now? Well, yeah, because it's the holidays, right?
Right.
Like if you're about to go off for the next 2 weeks for vacation,
right?
Why buy the dip now? And that is one thing that if this wasn't December, you might take a different approach to looking at the chart this way, because the liquidity just might not be there now until January. I want to say January 2nd, but realistically, there's no non-farm payrolls report on January 3rd this coming month. It's going to be January 10th. So you're really talking about liquidity returning January 6th.
Yeah.
Why might as well just wait.
Yeah. Like it doesn't seem like there is any hurry here. Even if your perspective is this is not a larger thing, there is really no reason in my mind to say, you know what, we've just had a clean break of a trend that's lasted since early August. You've had a clean attempt at rebounding today that got rejected outright across the board. Why would you try to fight this right now? I would think you'd want evidence. That doesn't mean that you have to be short. In fact, I think if you haven't been short, then I would not be getting in now, because at this point, the risk reward is kind of shot. But that aside, I mean, if your disposition is you're not going to sell because you think that buying the dip is always the right move, and Lord knows there's a whole generation of folks out there with that mindset. Although I wouldn't actually put you in that camp, because you were there in markets in '08. You were at least looking at them. You remember, as do I. And so, but there's a whole generation of people out there that have no clue what that's like, and that only saw COVID, which frankly was a brief aside, because frankly the Fed learned the right lesson from '08 and didn't put little tidbits of QE out there. They just went and said, it's free money, it's unlimited, everybody sit down. And it worked. So I would say at this point, if your disposition is, you know what, the market always goes up, the Fed knows what they're doing, it's working, everything's fine, this is not the risk reward spot to be a buyer. There's no evidence there, in my opinion. And if you're a seller and you haven't been short, why would you sell directly into support? The risk is actually that you bounce here.
We do have a PCE index reading tomorrow morning.
Yeah. PCE
is something that's typically overlooked, but I don't want to say that it's PCE that's driving the market move. We look to the one-day expiration, 53.8. We'll call it 54 points priced in through the end of the day tomorrow. So just under 1%. That's pretty good. We haven't been looking at moves like that in quite some time. So vol has certainly come in across the curve and expected to persist. We don't see a reading with IVRs below 20 now at any point across the curve through the end of, dare I say, 2027. So vol's inflated, Ilya. It's a 53.2 IVR. I mean, if you were to take out the early August spike, you'd be looking at one of the highest volatility readings that we've seen all year long right now. And I think it's because the market's telling us, when you look at the bonds here, that the Fed has just made another policy mistake.
Either that, right? or either that, or I've been toying with this idea for the past 24, 48 hours that what the Fed is doing is basically judo. That the Fed is giving the markets what they want, and in so doing, throwing them off balance. Because what the market is used to is a gradualist Fed. We've talked about it here. I was expecting a more gradual Fed out of this December announcement. I was expecting a Fed that didn't cut its 2025 rate outlook in half, which, by the way, is exactly what the markets were telling it to do. And they delivered. Look back September. Again, the Fed gave the markets all the dovishness they wanted. And the markets went, wait, what? And then spent 2.5 months rallying up yields, rallying up the dollar. And the Fed didn't do anything that the markets weren't expecting. Everything that the Fed gave them in September is what the markets had priced in. But once they saw that the Fed was going to go their way, they got spooked. It just happened again. So, as with judo, when your opponent tries to lunge at you and use their force, you don't resist. You pull in the same direction. And your opponent is thrown off balance. Kind of looks like this is what the Fed is doing here. And kind of looks like how you would manage a soft landing.
Oh, I don't know about that. If you're so worried about inflation ticking up by 0.4% up in 2025, more so than where it was in the September forecast, why on earth cut by 25 basis points right now?
Well, because I don't think those forecasts really speak to anything. I think it's the rates forecast that actually matters.
But here's why I read this as a policy mistake. The market right now, Fed funds futures for the end of next year, are pricing just over a 4% Fed funds rate. That's where we were more or less back at the end of November. There hasn't been a significant dislodging. If we can go to the M5 contract for June, we are literally pricing in the same number of rate cuts through June as we were back on November 25th, back on December 2nd. So this isn't there hasn't been a huge shift here. The market, by and large, heard what it thought was going to happen. But in doing so, there's also the sense the Fed also may have made a mistake, because why on earth then would you cut rates? If you think that the unemployment rate, you've just boosted your unemployment rate forecast, saying the jobs market is going to be stronger than you thought it was going to be. You just boosted GDP for this year. You boosted GDP by a little bit for next year. You're telling us that inflation is going to be stronger than either of the improvement to GDP or to the unemployment, right? Unemployment ticks up by, is it 0.1% improvement in terms of the forecast? And GDP, I think, goes from 2 to 2.1%. But inflation goes from like 2.1 to 2.5. So you're telling me that even ahead of an environment where growth and the unemployment rate are not going to move directionally as fast as inflation is, you still think it's appropriate to cut?
But look at what you've done.
Something's not clicking there.
Well, look at what you've done. Well, what you're saying, we've talked a lot on this show and others about the idea that there's cuts and then there's cuts, right? There's maintenance, which is to say you're trying to contain inflation expectations, but in containing them, what you do is you essentially bring down expected inflation as a calculation in real rates, which means that if you don't then move nominal rates down as you quash inflation, the real cost of borrowing surges and you crush the economy. So you don't want to do that. So as your rate hikes generate success, not only in bringing down backward-looking inflation, so CPI, PCE, but forward-looking inflation expectations. As you contain them, you want to bring nominal rates down so you don't destroy growth. At the same time, there is the other version. You cut rates because something has gone wrong, because you're trying to provide stimulus, because you want the economy to get hotter. The Fed can still cut rates next year while inflation ends up being higher, and it's made it very clear that given what it thought in September, it needed 100 basis points in maintenance. And that it's in maintenance is key, because the economy has not really fallen apart. Now they feel like they need 50, and they've extended the runway. And they said this in the statement. We are now expecting to see the same 3.4 median Fed funds a year later than we were going to get it. So not only has the Fed changed the makeup of the cuts, it's spaced them out a lot more.
Right.
So yeah, I mean, I don't think there is a meaningful inconsistency with their guesstimate on PCE here, especially since it really is a guesstimate. It's all of those policymakers throwing numbers into a bucket and using different methodologies, and the Fed going, oh, here's the median of the bucket.
Sure.
Getting stuck on that part of it is probably not where the insight is, because all of those economic forecasts come from different models, different approaches. All of these Fed officials have their own branch economists doing these things in different ways.
Right.
But if you look at the rates, their decision on what to do with rates up or down 25, 50 basis points, that's where you have the same yardstick. And so at least there, you get a little bit of a better like-for-like comparison for how their thinking is evolving.
One tool that I've touted out or trotted out in recent months has been the Taylor rule Fed funds heat map. Back in September, we were talking about how could the Fed rationalize a 50 basis point rate cut. And I was pointing to this, that if you were to look to the inputs for the Taylor rule, if you're thinking about inflation and GDP and the output gap, you were looking at a Fed funds rate that was, in the neighborhood of 100, 125, maybe 150 basis points too high. And so by starting off with a 50 basis point cut, the Fed would signal that it was taking steps to get back to neutral, and policy was still inherently restrictive at those levels. Okay, the market bought it somewhat. I mean, stocks continued to run up. Bonds obviously melted down for one reason or the other, but gold kept rallying. We even saw that the breadth was improving in late September, October, going into November. But now these estimates, if we're going to hold ourselves, I'm trying to be intellectually honest, right? Now that they've turned higher here, why am I kind of critical of the Fed? A lot of these numbers here are flashing readings that say that the Fed funds rate should be higher. That where we are right now, if we're looking at PCE, then, long run, it's okay. We're still restrictive somewhat. But if we think about where we are with core PCE has been running hot. You get a lot less of those red readings, which you kind of want to see here, and a lot more of these green ones. Green means that we're in excess of the Fed funds rate effectively. So by many measures right now, policy just got a heck of a lot looser. And that's why I read what's happening in the bond market as the Fed may be making a policy mistake. Because if you're going to be loosening rates in an environment where independent measures of monetary policy are suggesting, hey, policy should actually be going tighter, not looser right now, all you're doing is telling the bond market that they need to punish you a little bit more before the message is ultimately heard. And so this leg lower today, I find that to be I find the disconnect between bonds and the SR3 market today to be very fascinating. SR3H5 actually ticks higher today.
Yeah.
We're above the lows that we were at back in November.
It's the spacing, yeah. That they've spaced things out is telling you that actually where you want to be probably looking is like SR3M5, N5 for things to start to show up.
But it raises the question, right? If inflation isn't realized here, right? If inflation doesn't bump up in the night for reasons other than base effects, and the economy continues to grow at a 3% or so clip, Atlanta Fed GDP now has it growing at 3.2%. We just had the final reading of the third quarter GDP release, if I recall correctly. Why am I spacing on this? 3.1% from 2.8. There we go. So
white hot.
That's very hot, right? And I'm reminded of the fact, we look to where we're pacing now. We're still pacing right over 3% by the Atlanta Fed. So in an environment where we have growth positive in the quarter, that the Fed started to cut rates, what are the long-term return profiles for stock? And they are typically still positive, right? These are still maintenance cuts. But the Fed needs to go into a long period of pause right now. And it's that I think the greater issue here for the market is the path uncertainty moving forward. And if we see that there's a government shutdown potentially looming, apparently in the last 15 minutes or so, House Republicans have reached a new deal. I have yet to see President-elect Trump, or Vice President-elect Vance weigh in on it. I haven't seen any tweets from Elon Musk about it so far. So we'll see how this plays out. This could potentially be part of the risk for bonds. But my goodness, glad that I've structured all of these bullish ideas like this one. God, I've been so hard in bonds notes the last few months. It's killing me. I got long on December 6th, Ilya.
Yeah.
It's just terrible timing.
I mean, I can't say that I've done a whole lot better. I've been holding the bonds for the long side for what, about 24 days now, so that would be late November.
But yeah, you were in at a better level than I was. That's the thing.
Yeah, and So I bought that low. I mean, it's upside down, and it's risk defined. And thankfully, it's risk defined at only about 1.5% of equity, so it's not a big loss by any stretch of the imagination. But I'm basically at max loss now, with 15 days to expiry. And if this keeps going, I'm just going to let this thing expire worthless. Take my 1.5% of equity hit. That's peanuts relative to what the stocks shorts are doing. So fine. That's the cost of doing business, but no good on the timing.
The other day we mentioned how, because of just the timing of December, TLT goes ex-div twice this month, December 2nd, December 18th. And so you see today that TLT is down by 1.51% relative to either ZB or ZN. ZN is off by 0.34. ZB, the more relevant futures product, off by 0.90, again, because of going ex-div a little bit, helping with that downdraft. So it's just rough out there right now. But, the upside of this move in the bonds is if the inflation doesn't materialize, right, then you have a runway for the economy now. A continuing resolution further reaffirms that the economy is going to get the spending that it needs for the next several weeks. So those deficits and debts don't really change off their current path. Fed rates are now lowered a little bit more, and while they're probably not going much lower for the foreseeable future, the impact on the real economy is going to take a lot of time to process that. So isn't an influence on markets in the short term. No Fed cut in January, probably not in March. It's a 50-50 shot right now, but most likely before June, and then maybe we don't get another one. So the end of the Fed cut cycle is here. We got 100 basis points in cuts since September, and that's it, apparently. Apparently we're done. Ilya.
For a while at least. I mean, if you look at what Fed funds is baking in right now, you're looking at 37 basis points for next year. and 20 basis points for 2026. So you're looking at a 57 basis points cumulatively over the next 2 years, which it's not a lot. What's interesting here is, and I'm going to talk about this in granular detail on macro money after this. And by granular detail, I mean I'll bring charts so you can see this visually. So don't despair if you get lost in my macro machinations here. But if you look at what happened in September, right? Again, the Fed gave the markets exactly what they wanted, but it threw them off balance. Why? The Fed said, yeah, okay, 100 basis points now, 100 basis points for next year. You get a car, and you get a car, and you get a car. It's a car for everybody. Market wait, but the economy is heating up. This is going to be reflationary. And changed their mind as soon as the Fed confirmed for them what they wanted to see. So then you get the 2 months of higher yields, higher dollar. How do you know that that's what happened? Well, because by the time the Fed makes its announcement, U.S. economic data as of late August is already heating up relative to expectations, if you look at Citi's surprise index. So when the Fed delivers all of its dovishness, the economy is already showing signs of picking up momentum. Well, it's the flip side now. U.S. economic data has started to cool relative to forecasts in mid-November and has continued. Fed comes out, does the hawkish thing. Markets go, oh no. It's bizarro September. It's September upside down. And so now the risk is actually the data starts to surprise on the downside, and the markets end up being off sides. And bonds come up, and gold comes up, and the dollar comes off.
Dollar's at its highest level since November 22. It's a good performance buttressed by a yen that gets slapped around to a 1.76% loss. Oh, here's a silver lining on a gloomy day for bulls, at least for me, because those yen puts, which were sitting at, basically going to go out for nothing a few days ago, I said, well, what the hell? We're looking for 0064. We're now at 0067.5. They got 2.5 weeks, 3 weeks to go. I might as well just hold on to them. Makes today a little less painful in some regard.
Yeah.
But today really wasn't. Yesterday and today were really not that painful, all things considered. I was looking at the market and seeing how the dust settled. It's like, oh, we're down like 3% or so. I'm off about like 2.7%. Okay, not bad. Outperforming the market. Hey, silver lining. So yeah. It's been a good. I was talking to my wife yesterday about this. I was like, oh, yeah, the market got killed today. She's like, isn't it still up like 20% this year, though? I'm like, yeah. She's like, so who cares? It's like, yeah. Who cares? We've been along for the ride. We're not going to get worked up over it. But the yen here and the dollar are now, kind of at odds because you have a Fed that's saying, whoa, let's pump the brakes on this rate cut cycle. And the BOJ last night has their own meeting, and they dither. They're not exactly keen to move here.
Go. Yeah, they don't go.
And my working thesis a few days ago was, we think about the Fed and we think about the Fed's position relative to other central banks. Europe is dealing with worse conditions. The UK is dealing with worse conditions. Canada is in a free fall. The GDP per capita in Canada hasn't grown in like the last 8 years, mostly under Trudeau. I don't know if there's a connection there, but it's worth exploring. We think about what's happening basically in any industrialized country in the West, right? Their currencies are in trouble and the central banks are being forced to ease. And there's a lot of coordinated global easing going on right now, if you believe it. But the problem is the Fed now is saying, no. And so you see emerging market currencies hitting new lows for this year, all-time lows, like the Thai baht, the Indian rupee, the Singapore dollar, struggling, right? Curiously, the Mexican peso today is up by 0.31%. Canadian dollar has a little bit of a rebound. But the big guys, the euro, the pound, the yen, which are the pillars of the the dollar index, together constituting, we'll call it 82 or 83%, right?
Yeah.
57.6,
There's really nothing in the dollar.
11.9.
There's really nothing in that dollar index that I mean, other than the Canadian dollar, if memory serves, but the Aussie is not even in it.
No, it's the Swedish krona, and the Swiss franc. But you go to the British pound, for example, this being like 11, just under 12% of the dollar index, it's now closing at some of the lowest levels that we've seen in several months. You have to go back to where we were.
Bank of England didn't help,
and they had their meeting today.
They were much more dovish than expected. We talked on Macro Money at length yesterday about how they were kind of between a rock and a hard place, and how they can get through that will be volatility inducing one way or another, because there's really not a very good answer. Their economy is slowing. The PMI numbers at the start of this week showed that we've basically slowed back to standstill, some of the weakest growth we'd seen out of the UK all year. And at the same time, inflation came in hot. And what's striking is that it came in hot, and the biggest pieces of doing that were discretionary spending, hospitality, recreation. And these are the things you would expect to start to fall away with a cooling economy, and they're not, which makes you wonder how much COVID labor market lockup for the jobs in that space, especially the service sector jobs in that space, much like the U.S., if that's just keeping inflation from falling away. And what the Bank of England then needs to do, how much more pain does it need to inflict? Because at this point, it would have to inflict a recession. So they were kind of stuck. Do they cut? Do they not cut? Do they signal hawkish? Do they signal dovish? Because growth and inflation are going in opposing directions. And although they opted to stay, it was much narrower than expected. It was supposed to be 8 out of the 9 of them voting to stay. It was only 6.
Just a quick note here. I just got to see the notification. Trump has endorsed the Republican plan to pass this continuing resolution to fund the government, according to the Wall Street Journal. Trump endorses a new plan by House Republican leaders to try to avert a government shutdown this weekend, a day after he killed a bipartisan deal. That's the Wall Street Journal's news alert. Bond yields slightly lower here after hours. Equities, they ticking up a little bit off the lows. We're down at 59.32 immediately after the close. We're now back to 59.42. So 10 points between friends. That's not hurtful here. Ilya, the question is what's doing now in the metals? I have to say, I've talk about sometimes the structure of the market helps me because I just don't get filled on positions. A few days ago, I was kicking the tires on silver, and I couldn't get filled on my long 33, long 34, or short 34 call spread. And thank goodness that happened on Tuesday, because yesterday and today would have been, listen, it would have been, those trades are structured 25 or 30%, blah, blah, blah. So I'm risking 1 to make 3 or 4, and it would have been a loser.
Yeah.
But it would have been a big loser. Selling puts would have been obviously crappier. And just by the function of the fact that I tried to do this in SI as opposed to SLV is probably why I wasn't able to get the trade in, because just SI futures aren't the most liquid deep contract. So the question is, now that I don't have any capital at risk, I get the opportunity to look at this with kind of fresh eyes. Mm-hmm. And this looks awful. Now that I'm looking at this without a position on, it looks like a head and shoulders pattern that broke down through the uptrend from the August and November swing lows, and volatility continues to just creak lower, even with that big price move. Gold, silver, they're all just looking like crap. The gold positions, unfortunately, I still have on. So I can't say that
gold looks much better, actually.
Does it?
I think so. And if you look at where gold is here, you can sort of draw a line at the August kind of swing highs, sort of the top of that range. It's a broad range. I mean, it goes all the way back to April, but if you look at just the August 20th high and you put a line across the chart, you're basically at former resistance come support. So if you were going to bounce somewhere, this looks like a place you might do it. And because support and resistance is never a level and usually a range, then I suppose you could give yourself leeway through into the November 14th low. That's what, 25.66. So you have then a kind of area of support, and you kind of held it today. You didn't break down. I think if you think bonds are overcooked, if you think the dollar is overcooked, then this is overcooked. And so
that is the same story, yeah.
It's the same story. And the added benefit here is China is buying for their reserve account again. We just saw numbers, of course, for November that said that was the first month since April that they were buying again. When they paused in April, the preceding 18 months, they were buying at an accelerating clip. If they, for whatever reason, thought that this was a good time to buy some more, that, again, there's an if, but if that reflects their perspective that the price has become attractive, then where are we? We're basically the same areas we were the beginning of November. This is a place where maybe they're interested in buying some more again. So I'm actually happier with gold. Silver, on the other hand, looks terrible. And it's probably because silver is not a precious metal only. It also has some risk sentiment sensitivity. And the very same range that is now holding in gold is decidedly not holding in silver.
Yeah, it's not holding in silver. It's kind of holding up right now in copper. It's such a stretch of a claim. Copper is down below 4.1 a pound. And you see here it's...
But China stimulus, they said.
Well, they're anemic to the proper kind of stimulus that they need.
So it seems.
Supply side reforms.
I will continue to gloat at their ineptitude until they get better.
We're sitting in this zone. Volatility is not that high. Gold, copper, silver, all kind of struggling here. We see if we get a bounce out of gold. China's buying in force again. If they were buying down here back in November, because apparently they restarted their buying operations in November, I can't imagine that they wouldn't put in a line of defense here as well. If we do break down further from here, where to? Maybe it's down at 2,500, but this has been a sucker's trade on the long side, right? You just got to admit when they get you. The breakout here looked awesome. And then we clear the engulfing bar high. Fantastic. Mm-hmm. That was a one-day event. One-day event. Got sucked in on the wrong side of the trade. Sometimes it happens, Ilya. Let's talk about crude, though, because this is a day where really nothing happens. Crude's modestly lower here. It's up by 1.1%, but in the grand scheme of things, it feels a lot quieter than some of the other markets over the course of the session. We're still between 66 and 72. We can't seem to shake ourselves outside of this range. For all the warts that every other asset class had, energy's been relatively constrained this week. Mm-hmm. Why so boring right now? There's so much going on in the world. Is it just all too much for crude, and crude's kind of closed its eyes and plugged its ears and just taken a rest for the rest of the year?
There's a lot of uncertainty here. Because
it's a 20.4 IVR.
Well, there's a lot of uncertainty if you want to make a bet. And so I think the perspective that seems to be getting reflected in this coiling up is, you know what, nobody just wants to have an opinion. And that's why the IVR is so low. If you thought that things were going to go badly or become volatile, yeah, you'd see higher readings if you were concerned. But if you just didn't know, should I be concerned? Should I not be concerned? Then you just take your hands off the wheel. Take the keys out of the ignition, not drive anywhere. So I think that's what you're seeing here, is just a lack of conviction to make a bet. And it makes some sense why. because the situation in Syria in particular is incredibly fluid. The situation with the Russia-Ukraine theater is suddenly a lot more fluid. And the situation on the U.S. output story, of course, as a consequence of the election, adds a wrinkle. Because on the one hand, you ostensibly have the drill, baby, drill administration coming in, but how much more can you drill, baby, when you're already producing record output and the U.S. is a larger petroleum producer than Russia and Saudi combined? It's not going to be easy. You're going to have to turn on a bunch of rigs, and granted, they're there to turn on. The number of active rigs has been falling. The number of active fracking extraction sites has been falling. We've become more efficient at getting more output out of less infrastructure. If you want to really ramp up and keep going, you're going to have to turn some of this stuff back on. It doesn't turn on as fast for regular rotary rigs. It can take months. Fracking is faster. So the supply story is a long path, a long kind of downwind runway to more supply. If you get into a situation where what looks to be Iran on the back foot, with now not only the loss of Hezbollah and Hamas, but also Syria, if that means that at the very least they're not going to do anything aggressive for a while, just going to sit down and retool, then not much risk. So as you get into next year and some of these confusing threads start to get rationalized in the market's mind, maybe what you find is geopolitical risk premium should come out. The supply story is more than abundant. It's an ocean of crude out there. This is just waiting to break down.
Elliot, 2 points of interest. Nike and FedEx both reported here after hours. FedEx is up around 7% here after hours, but not because the earnings were particularly great. Second quarter earnings were $4.05 a share, which was right on the nose for the estimates, up from $3.99 a year ago. But revenues were smaller, $22 billion, short of consensus of $22.17 billion. They're separating the company in two. FedEx and FedEx Freight will be two independent public companies moving forward. So, you think about FedEx being a parcel deliverer, this could be a leading indicator for the global economy. Well, the actual reason why it's trading higher here is because there get to be a little bit more financial engineering in the future. Nike, on the other hand, maybe this is just a relief kind of thing. They have a new CEO, Elliott Hill, who just finished up his first quarter, and the results were better than expected, 78 cents versus 63 EPS, revenues of $12.35 billion versus $12.13 billion. So they're enjoying a nice little bump here after hours as well. Any broader read-through for the economy? I don't know, particularly because FedEx's results are not that great and kind of feel a little bit muddled if you think about the breakdown results. So that's really it for the earnings stories here. I mean, what else is there to look forward to now on the calendar as we turn our attention to these final few full trading days of the year? Tomorrow, if you care about cruise lines, Carnival Corporation's reporting at the start of next week. There's BHP if you're into oil energy. On the 24th, San Juan Basin Royalty Trust, market cap of $177 million, is reporting. Thursday, Friday, nothing else. We are done, dusted. The calendar is winding down for the year. Are you expecting Fed officials to come out and try to massage this now as we think about, potential risk? Are they going to be the mindset that we've misinterpreted what they intended for us as we move forward now here into the end of the year?
No, I don't think that they have anything to say, and I don't think that they think that the market has misinterpreted. I think this does not present any kind of a problem for the Fed whatsoever. In fact, if you look at what the bond market has been doing and what the Fed has been saying, it's a really nice dance. that's been going on basically since the Fed kind of got frustrated with itself in the first half of the year and then seemingly changed its approach. If you consider what the Fed was doing at the beginning of the year, they look like they're behind the ball. They come in and they say, we're going to do 3 cuts in 2024. And the market tells them, no, you're not. It doesn't make any sense. Inflation is stalling. Your progress that you think you're going to be making, it's not there. The Fed resists in March. They resist all the way into May, which is where this gets really interesting. The market is slashing rate cut expectations from the start of the year and into mid-year because the economy is heating up and the Fed says we're going to do 3 cuts and the market goes, yeah, okay, no. Mm-hmm. The economy is heating up. What are you talking about? In June, the Fed goes, okay, fine. 1 cut. But of course, by then the economy is already cooling again. And the market goes, well, you got it wrong again. Or the Fed has figured out that the way to throw the markets off extremes back toward the middle is to give them the last thing they wanted. Because if you're going to engineer a soft landing, you don't want the markets to over-extrapolate this or that. You're fine-tuning. You don't know where the balance of growth and inflation are because you've gotten to the point where you can't really solve the problem with a hammer. You have to go in and do a scalpel-like approach. This isn't the beginning of 2022 where inflation is obviously out of control. You have to do a lot of hiking. Fed starts doing 75 basis point hikes in a row. This is not that.
No.
You don't want the markets to overthink things.
No.
So you throw them off balance. Now for a third time.
Ilya, we talk about this week being the week of a potential blow-off top. This is the week where if we think about the riskiest of risk, you see that Bitcoin tops 108,960 in the futures market on the 17th. We're now back to 96,505. And this little bit of an uptrend we've been trading in since the post-election breakout, it's starting to creak. We think about the dominoes as people are investing or allocating every incremental dollar. You're putting stuff in here because you're reaching for return, reaching for yield, reaching for risk. And if you're abandoning this, you're abandoning the NASDAQ. You're starting to see credit spreads widen out a little bit more. Again, de-risking before the holidays right now, but that doesn't preclude a Santa Claus rally from happening. We'll see what the price action tells us moving forward, of course. But the number of stocks below their 20-day moving average now at levels that typically coincide with bottoms. So I got time here, Ilya. The bond position can't get any deeper underwater, right? We'll hold on to it for now.
We got time. We're at support. Let's not freak out here.
Unfortunately, we have time. If this was 0 to easy, we'd put out of our misery, but instead we are not. But that will be a problem for Monday, which I think will be one of our last shows altogether for the year. So be sure to tune in. But with that, Overtime is now out of time for today and this week. See you on Monday, December 23rd. Until then, good luck trading. For Ilya Spivak and Chris Vecchio, who's me, this has been Overtime. Gosh, crash landing here. Up next, after a brief break, Tasty Live continues after dark with Macro Money and Ilya Spivak. See you there.
See you there, everybody. It's a quiet day after what was a Fed-induced collapse, for lack of a better term, around equity markets. The Fed seemingly shocking the markets with their policy announcement. And we'll take a look at what that means here. But as the markets digest, we are getting an opportunity to take a little bit of a deeper dive into just what the Fed has done and why and how this portends to resolve itself going forward. Because clearly the market's at a violent response, and in the Fed's doing and in the triggering of that response, there is perhaps a signal for what their strategy is going forward. And what we're calling it here on Macro Money, which is what you're watching here, I'm Ilya Spivak, head of global macro at tastylive, is Fed Judo. And we'll talk a little bit here why this is what we have, why this appears to be the maneuver that the Fed is employing, and what the trade is in all of this, because there does seem to be one. So let's first and foremost take a look at what the markets did when the Fed made its announcement. Needless to say, risk appetite was not happy. The S&P recorded a 3% loss, NASDAQ almost a 4% loss. Yields surged by almost 3% across the curve. 10-year up, 2-year up. Crude oil, of course, continues to march to the beat of its own drum. It doesn't seem to be paying attention to anything. But the higher yields give us lower gold and a stronger dollar, a euro off, yen off. And the risk-off environment lands directly atop Bitcoin and sends it down almost 6%. So, needless to say, risk sentiment didn't like this, what the Fed did, and the upshot of how the markets read what the Fed did was hawkish. Dollar up, yields up, and risk didn't want that. So, what was it that the Fed did, and why did the markets not like it? That's, needless to say, the key question here. So, let's take a look. Here's December's summary of economic projections. We won't even bother with the fully expected rate cut that the Fed delivered. It was already being baked in at well over 90% likelihood ahead of the announcement, so no big shock there. And frankly, we can see that back in September, the Fed projected that it would give us 100 basis points in cuts. It delivered exactly in line. When you come out in September and say, we're going to do 100 basis points in cuts with 2 meetings left and 50 basis points up front, it's really not a stretch to say, oh, you have 2 meetings left, you just gave us half, you're going to spread out the rest over the last meetings of the year. So you're going to give us a 25 basis point cut in November, another one in December. You're issuing this forecast in September. You really don't have a lot of time to see data to change your mind. It's probably locked in. So, and by the way, 4.4 is 100 basis points in cuts because, of course, the Fed operates policy in ranges. So the median jump-off point for Fed easing, which begins in September, is 5.4. That's the midpoint between 5.5 and 5.25, which is the Fed's range before it starts cutting. So when the Fed says that in 2024 rates will be 4.4, that's 1% or 100 basis points off the median. And the median is the starting point at 5.4. So there's that. Nobody really was speculating around this. The real question was what would happen next year. And in September, we can see the Fed said 100 basis points in cuts next year. So we're going to go from 4.4 to 3.4. And here they went to 3.9, which is to say they cut the forecast in half. Rather than 100 basis points next year, the Fed said 50. And now, notice, that 3.4 has moved into 2026. They've elongated the policy path. They've said what was going to take us 1 year will now take us 2 years. So the Fed said, we are going to cut, but less, and we are going to space the cuts out much more. Notice this end point of 2.9 doesn't even appear through 2027 anymore. So the scope for cuts has narrowed. Their length in delivery has extended. We end up at 3.1 in 2027, and of course that's a very long view, and the Fed's going to change its mind a bunch of times. Needless to say, the market is going to change its mind a bunch more times on what this is likely to look like before then. But the upshot of what the Fed does is it makes a hawkish adjustment. So that's why you get this response. Now, what's incredibly interesting about this is by the time the Fed makes this move, this is precisely what the markets were calling for. And so the idea that they're surprised by this and that this throws them into some kind of a imbalance, that risk sentiment cools and that yields shoot higher, that's the interesting bit. And this is where the judo component comes in. Now consider this. The Fed, as we just said, went from 100 basis points to 50 basis points in 2025 cuts. Where was the market before the meeting? Right here. So this is the last remaining bit that was there for December. But for 2025, 50 basis points. And that's after a long 2-month, 2.5-month readjustment where the market was a lot more dovish. And when the Fed made its 50 basis point move in September, got a lot less so. So the Fed essentially just trued up their outlook to where the market already was, yet they were thrown off balance anyway. What does that mean? To follow this story, we really have to go back to June and figure out how all of this fits together. Because one interpretation might be, well, the Fed is constantly behind the ball. But another might be that they appear to be behind the ball like a fox, and that what they're really doing is using the market's own momentum against them to deliver the policy results that ultimately they want to achieve. So let's consider. We get to June. This is the June summary of economic projections. Notice this marks a hawkish shift for the Fed. So again, remember the starting point is 5.4. This is where we are on rates in the context of this forecasting before the cuts begin. In March, the Fed projects 4.6, and in June, it pointedly goes for just one cut from 5.4 to 5.1. Right? This is rounded off to 1 decimal point, round off a 0.25 cut to 1 decimal point, you get 0.3. So from 5.4 to 5.1 is 0.3, one cut. Now, why is the Fed adjusting this from 3 cuts to just 1? Well, if we look at what's going on in the economy at this time, recall, this is June, what we're seeing is a little bit different than what we had been seeing. At the beginning of the year, the economy is heating up. U.S. economic data, looking at this Citi Economic Surprise Index, is actually improving relative to expectations. And it holds here basically through March and into April or so before there's a turn. How do the markets read this? Well, they start the year with a very dovish expectation because the Fed told them back in November of 2023 it's going to start cutting. But then the economy is looking hotter. And so these rate cut expectations start to go in. I have here the entire cycle in the orange, at least through this year and next. And you can see the market moves substantially here, over 100 basis points to a less dovish setting. That is fewer cuts. And at this time, the Fed comes out with their policy announcement in May and bemoans that inflation has been stalling and that we need to see it continue to decline. And come June, all of that seeming frustration gives them this hawkish adjustment. But of course, by then, the economy is already turning the other way. You start to see U.S. economic data begin to cool relative to forecasts in mid-April. You start to see it really start to underperform before the Fed even meets in June. So what does that do? The markets start, oh, wait, we need more cuts. And if the Fed is resistant to cutting in 2024, well, maybe they'll cut more next year. So the wedge between the outlook for this year and next widens out. So the Fed either could be looked at as behind the ball, or they could be looked at as forcing the markets off this setting back to the bottom of the range for where expectations find themselves. What happens as a consequence? Bond yields come down. The dollar comes down. The yield curve has a deeper inversion. Inflation expectations come down. The markets at this point are saying, oh, the Fed is reluctant to cut. They're going to kill the economy. Inflation expectations are sliding. It is into this that the Fed then comes back in September and goes, oh, you want more easing? Okay. Sure. Here is more easing. So when you look at this here, by September, the market is looking for an expansive easing cycle. And the Fed goes, okay, there you go. And they go from 5.1, which is one cut, to 4. Not only that, but they give a lot more easing for the subsequent year. And the market goes, wait, really? But U.S. economic data has already been heating up again by the time the Fed meets. And the market suddenly looks back in context and goes, wait, so they gave us everything we wanted again. The markets were calling for more easing. The Fed gave it. As a matter of fact, it gave about exactly as much as the markets wanted. Notice they wanted 100 basis points for this year. Exactly what the Fed gave them. They wanted a little bit more for next year, 130. The Fed gave them 100. So a little bit less, but at this point, that's a year and a half away. There's a lot of time to rethink that. So the markets seemingly are caught off balance again. They look back here and they go, oh, but the economy is heating up again. Now all this easing looks wrong. Now what's going to happen is all this easing is going to reflate the economy. Inflation expectations come right back up. Bond yields come right back up. Dollar soars. What do we get now in response to this in December? That goes, okay, you want less easing now. Here you go. And the market is thrown again. If we look at the adjustment in the yield curve from September even into November, we can see the market is aggressively calling for less easing. If we look at the way the curve looks now, and indeed the way it looked at the policy announcement earlier this week, there is a strong clustering here. All of this was mainly done between September and November in terms of the likely policy path forward. So what happens when the Fed gives the markets exactly what they want again? They overshoot again. They're thrown off balance again. And here's our first look at the 2025-2026 chart. We can see the markets are now lighter than the Fed, just 37 basis points for next year. They have 57 basis points over the next just 2 years' time, a little bit more. And this is what makes things interesting. Because now that the market has been thrown off balance again by the force of its own speculation, we get a sense that, wait, maybe we're on the wrong side of the ledger again, because now the U.S. economy is already cooling and has been since mid-November, at least relative to expectations. Not in absolute terms. The PMI numbers we got earlier this week on where U.S. economic growth is in December were white hot. But and of course, the GDP revision as well, 3.1% for the third quarter. But relative to expectations, we're cooling again. And so maybe we are once again in a place where the Fed has thrown us to the opposite end of the range. Why does the Fed want to keep doing this? Well, if you're trying to fine-tune because you feel like you're close to being at the neutral rate of interest, if you're trying to fine-tune because you feel like the balance to employment and to inflation, the dual mandate that the Fed has to meet, if you feel like the risks there are almost in balance, you don't want the markets to over-extrapolate this or that. So when you get to tops and bottoms in this range for expectations, which have roughly, over the course of the past year, moved between 80 basis points and 200 basis points, going all the way back to the start of the Fed easing cycle, signaling in late September, October, going into November's policy announcement, then rather than push back against markets, what the Fed seems to be doing is just handing the markets what they want so that the market's more reactive, speculative forces, because the markets are, of course, on a much more volatile reaction function than a central bank looking to get things right in the medium term, which is typically 2 to 3 years. The markets are obviously speculating on a much more shortened time frame. If you don't want them to get out of whack, it seems what the Fed has figured out is you give them the last thing that they've wanted because the market's front run. We can see here all of this adjustment was made going into December. Most of December was really no change at all. From mid-November here, this was done, the market's corrected, then in December reset to where mid-November was. And the Fed's perspective seemingly is we'll give the markets the last thing that they adjusted for, and by then they're already there and find their speculative reach has overdone it. If we look at the price response again, notice we're right back to where inflation expectations were back in May. We're a little bit higher on the dollar, but we're not too far at all on yields, right back to where this back and forth started, as though the Fed is employing judo-like tactics. to keep the markets from over speculating and over extrapolating one way or another, because they're trying to engineer this soft landing and they don't need the markets to reach too far in any direction. This makes for an interesting sort of going on as we get the last bit of economic data for the week. This is the PCE inflation index. It is the Fed's favorite inflation gauge. We're expecting a pickup here, much like we did from the CPI numbers that were released earlier. And in fact, when the CPI and the PPI numbers come out, we saw that last week, we generally have the components we need to build a PCE model that is very close to expectations. So the markets very rarely get this number wrong. So there's probably not a lot of surprise risk here. 2.5, 2.9 on the headline and the core, respectively, is probably pretty close to what is going to end up coming out. And of course, what that'll confirm is exactly what the Fed just told us, which is to say that the path to disinflation has slowed, which is why they've become ostensibly less dovish. We can see the increases in monthly core PCE have been greater. The increases in headline also a little bit greater, though less than core. And the speed at which this is moving has been in the wrong direction. In particular, the 3-month annualized rate for core PCE has been going higher. And so that's, of course, not what the markets want to see, not what the Fed wants to see. Even the 6-month rate seems to be stalling. But what we have here now is, of course, data is starting to get cooler relative to forecasts. If this data is close to in line, which would be 0 here, on this index. So if we're getting to that setting and the data starts looking like it's closer in line with expectations, and there isn't a further push into this hawkish direction, then maybe this starts looking overcooked, like the market's overshot again. Precisely what the Fed might want them to think. In which case, you get a correction. And maybe then bonds come up off the lows, and the dollar comes up off the highs, and gold rebounds, because again, it looks like the markets got knocked across their own feet. That is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm back with Chris for Futures Power Hour on Mondays and Fridays, on with Victor Jones for The Price of Truth on Wednesdays, on with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com. You can find most of what we talk about here on this show in written form, summarized, so that it's easier to follow. And likewise commenting on the platform formerly known as Twitter, as well as now on Blue Sky, at Ilya Spivak. This show is also now live streamed along with all of our post-market shows on YouTube at Tasty Live Trending. So if you want to comment in real time, go to that stream and do that. Thanks very much for watching. Macro Money's back next week.
Hello, everybody, and welcome back to Bad Taste. My name is Julia Spina, and joined with me today is my regular co-host of Bad Trader, Luis. Luis, thanks for joining me, dude. How are you doing?
Hey, Julia, awesome. Thank you for having me here. What a day today. Ended up, they actually read, I don't know if you saw the last minutes, well, the last like 15 minutes on the NASDAQ and the S&P. They were all over the place, but I'm good. How was your portfolio? How did it end it today, Julia?
It's red. Yeah, it's red 2 days in a row. Yesterday was a rough day, I'm going to be honest. And today, it started out strong, and then we just bled. We just did a slow bleed, which was another red day. Honestly, the move in the morning kind of made sense. Like, okay, kind of a bit of a correction after a very big move to the downside yesterday. It was like a 2.5 sigma move, which does not happen a lot, obviously, with diversified market indices. And so, yeah, having a bit of a reversal of that kind of made sense. And then we just bled out Oh man, my portfolio. But you, being a perma bear, did you have a good day?
Yes, I actually had a really good day today and yesterday. The ones that I actually went long, the Dow Jones, I ended up having 50 shares when you and I were on stream, cut them to 25 shares, and they ended up in the red. No surprise after today's weakness, but not that really bad of a day for the DI. Well, today they finally broke the streak of 10 days straight of negative closing, but they still have 11 days of closing red from the open to the close. So I'm long in the Dow Jones right now. That's the only ones I was only long. I'm short Palantir and long the yen. Those are my main positions that I actually ended up the day today.
Very nice. The Palantir, slow bleeding the market, but Palantir had a pretty strong day actually. Ooh, man, good days for the bears. Let's actually take a look real quick because we've had a couple flips. What did not flip is Micron is still. Micron had a really rough day today, down 16%. While Nvidia, actually at the time when we were streaming, it was not doing too bad. Moderna's up 3%. I think hell officially froze over. And Nvidia, I think did it flip by the end of the day? No, it's still up 1.3%. So Nvidia was green as well. So glad you had a good day. This Palantir trade is interesting. This has been just an absolute beast. It officially outperformed Nvidia looking at the last 252 trading days, is the strongest component of the S&P. And I have to actually recalculate those statistics because the last 2 days might have changed that. But at least as of recently, it's been a really strong performer this year. So continuing on today. My portfolio is not doing too hot. I threw in an AMD trade. This is kind of short term, 29 days out. My gold's Condor as well is like kind of the only one that's doing okay right now. Everything kind of donked after yesterday. Bitcoin as well. Have you been keeping up with Bitcoin?
Yes, I saw Bitcoin dropping almost like 10K from the highs of 108.
Yeah, tumbled.
I missed Coinbase and MSTR short today. I literally like to short those stocks.
I feel like you short MSTR like every day.
No, MSTU, I like to short MSTU, but after their 10-to-1 split, not any longer. I prefer MSTR plus. MSTU is a double leveraged ETF, and I prefer to stay away of those for the most time. But right now, MSTR definitely gonna see that tomorrow. If Bitcoin still becomes more weak tomorrow, I'll definitely add a little bit of a short position at MSTR for tomorrow, and maybe even Coinbase. I actually was with Chase on the stream yesterday. I like Coinbase below 300. Once it broke, it was a great short. I missed it because with all the Fed, Jerome Powell, there was so many short opportunities yesterday that just catching with all of them was a little bit hard.
Yeah, for sure. Really wild sell-off in crypto. It was just kind of a sell-off, especially yesterday. It was kind of a sell-off in everything. Like gold was down, market indices were down, Bitcoin was down. And it looks like, obviously there's a couple names. Natty Gas up 7%. I completely missed that. Oh my God, man. Well, there's a couple names that seem to be up: Boeing, General Electric, Moderna. But in terms of the rest of the day, yeah, just weird day. Kind of a weird day.
We got some stonks today, Julia.
What'd you say?
We got some donks today, FedEx and Nike after earnings.
Oh, that's right, because Nike just reported, didn't they?
Yeah, really good earnings. They were up almost 11% after hours. Oh, did it actually came back?
It kind of came back. It's almost, it's down a little bit, but not very much actually. For anybody who is watching, so on Bad Trader, we have these little challenges where you can wager in-app currency on whether or not something is going to stonk to the upside or donk to the downside. This is when it's hard to call because it is both a stonk and a donk. But all in all, we're not going to know till the morning. Actually, Nike that's like a little baby Peloton curve almost. Actually.
They had amazing earnings. Actually, they beat estimates. They beat their own guidance, both in revenue and in net income as well. So double beat for them and also for their next quarter guidance. But right now, it's currently their investors conference. So I don't know what their CEO or CFO is saying because that's definitely making them drop. Last time I saw they were up 11%.
Yeah, look at that. Well, yeah, we're not. Now it's pretty much flat. So we're probably not going to know until the morning. Actually, this is when stonk or donk is hard to call. A little surprised actually. I feel like with Nike it's a little bit more definitive than that, but there's still some time to go. Man, that's it. And then which else? What other companies company? There was another
FedEx.
big. What was it? FedEx. That's right.
FedEx. Yeah.
FedEx also had earnings. Let's see how they're moving. FedEx.
They're doing pretty good.
That's a stonk. Look at FedEx stonking up in here.
Yeah, they're actually going to be splitting themselves into two separate companies. So definitely the market liked that. If you see, there's a pretty interesting pattern for FedEx.
Mm-hmm.
All their past earnings, the stock actually either jumps or drops 10%.
You really get one or the other, don't you? Look at that.
Yeah, that was actually,
you can see that.
Look at those huge gaps.
These discontinuities are crazy. I mean, don't get me wrong. When you see discontinuities like this, a lot of the time it's because of earnings, but you just see it so like literally every quarter. That's so funny. I never noticed that actually. That's so funny.
Yeah, FedEx does move whenever they report earnings, and they've been in a like upward ascending channel that I've tracked it. I don't really trade FedEx, but yeah, it was something interesting that I saw. Like if you actually measure the gap they actually make from their earnings, tends to be like around 10% either to the upside or downside.
That's yeah. Well, there you go. That's a big move. Oh my god, and it's a big move consistently. I guess it's. I mean, slowly but surely trending up. I guess.
Yes.
And it's actually like it's so interesting to see this. Like the 50 and 200-day moving averages are like close to converging. Although now this is going to shoot. I mean, both of them up quite a bit actually with this big move that it's having now. It's up to almost $300. Wow, what a move! What a move that I didn't trade because I'm trying to be responsible in the, what is it, like 5 days that we have left, like 5 trading days that we have left in 2024?
5 trading days, and they're supposed to be the best days for December and the best days of the year. The Santa rallies are actually about to come. So
well,
let's see. I'm leaning short, but
well, of course you are. But like statistically speaking, like yeah, if it was going to come, it seems to be most likely based on historical trends to come. I guess tomorrow, right?
Yeah, but, well, tomorrow. Yes, I actually supposed to start the last 5 days of December, which tomorrow basically. So I don't really plan maybe trading too much tomorrow. I think I'll be happy with yesterday's shorts that I took. Also today, especially with futures, it was honestly somewhat hard to be scalping them today, especially at the end. They moved pretty well. The Nasdaq futures moved 100 points, like upward, downward, and then again sideways. Huge moves for them. So I don't think I'll be scalping them for tomorrow.
No scalpy poos. No, we're gonna end the year responsibly, maybe. Yeah, which is good. I did not buy my VIX calls. Maybe I should have, but yeah, I did not buy my VIX calls. I've never done.
Julia, every Thursday you say you're gonna buy something. It works out perfectly. Whenever you buy it doesn't. But when
well, it's because when I do actually go for it, it turns on me. When I do actually be like, I'm gonna pull the trigger. I'm gonna buy this like random like penny stock or something, and then it usually goes south.
QUBT, you were actually going to buy it on Tuesday, and it actually would have worked pretty well until yesterday. Today, really big drop for them. Look at 41%.
Yeah, but that could have dropped 41%. That could have happened at any point. Like, if it didn't work, it would have been, or if it did work, it would have been sheer luck and technically good timing. But yeah, that is how it often works, isn't it? Oh man, what a day. We got some stonks, we got some donks, we got some earnings. And you actually brought up an interesting statistic. I'm mentioning it now because I see that it's not in the slides that we're going to show in a second. But really interesting statistic, which is that on average, we get about 8 corrections in a year, like in a trading year. And we're actually, if you count the one that we just had, we're only at 5, correct? This was the 5th one this year?
No, it's actually only the 2nd one this year.
The 2nd one this year, Yeah.
And there have been only 5 corrections in this bull market since the start of 2022. There's on average 8 corrections in a bull market.
In a bull market. So just so that I get I must have misinterpreted the statistic, but just so that I understand it, in any given bull market, there's an average of 8 corrections, and this is our 2nd one since 2022?
This is a 5th one since 2022, but it's the 2nd one this year.
I see. And typically in a year, we would expect, you said 8?
It was actually 3 and 5 a year.
Between 3 and 5 a year. Okay, so we're still under
only
that.
2.
Really interesting statistic. Thank you for clarifying that. I remember it was interesting bringing it up sort of during stream, so I wanted to kind of share that a little bit. It's 4:44 at least Central Time. Make a wish. But we do have some slides, and if we got time, we're going to do a tradle before we kind of sign off. Do you want to hop into it?
Sure, Julia, yes.
Let's do it. Okay, so first things first, let's get into some slides. Lego. Do you see the slides?
No, I don't see them, but I can.
But this platform looks mighty fine, doesn't it?
Yes, it looks really good.
Hell yeah. Are you guys able to pull up the slides? Pretty please. We can keep looking at the market though.
Yeah, well, actually, right now, I might actually load up more on Dow Jones tomorrow.
It's okay. We can hop back in a second. First things first, yep. I see some really interesting stats in here, so I want to go through them. But we do have a little bit of market news. And first things first, we do have an app. So we made some sick updates this week. We have it's in review in the App Store. It's a pretty big one. It's going to be coming out hopefully today. Pulling the trigger on that. So if you want to come find us, we're in the App Store and the Google Play Store. Some really cool technology. We'd love to have you. And then as well, if we have time, we should. We're going to do a tradle. If you want to come throw your guesses over in chat, you can find us on Tasty Live's YouTube channel in the chat over there at Tasty Live Show. And if you want to follow us on Twitter, Luis does an awesome job of managing our Twitter, and that's @TraderApp, or I guess like X, formerly known as Twitter. So you can find us over there. So what stats do we got?
Well, for value investors, while I was on stream with you, I actually bought some shares for the value ETF, which has had 14 consecutive straight days of losses, which is longest streak in history ever. So I actually closed them for a small profit, the IVE ETF, which I'm definitely planning to enter tomorrow, because just 14 days of straight losses, honestly, I think is way too much. But it's not surprising after seeing a very weak market breadth, and I think a lot of people are starting to actually talk about it. So definitely I'm going to be eyeing it for tomorrow. One of the few long positions that I'm going to take is going to be definitely IVE. And also the Dow Jones, even though today was able to actually close on the green, it has closed for 11 straight days, going from green to red. So that's really bad. Well, not really bad, but I think it's also an opportunity. I ended up having 25 shares long on the Dow Jones. Definitely thinking on adding on these two long for tomorrow, which is, I think, very interesting to see, and uncommon stuff here in the Dow and also on the value stocks.
I was going to say, I'm just kind of eyeballing it, but this looks like, in terms of so IVE is a really interesting ticker. And this one you showed me actually on stream, and it's been kind of interesting to watch, especially because we're in this long down streak, and just kind of eyeballing it. I would need to calculate this more exactly, but just this has to be maybe one of the longest streaks to the downside that we've had in the last 4 years, with an exception maybe appearing in 2021. But really significant devaluation in value stocks, which IVE ticker. Brandon, awesome to see you. Thank you for joining us. I didn't know this existed, so it's really actually cool to start kind of tracking that. And some of the biggest holdings, I'm looking at this page now: Berkshire Hathaway, JP Morgan, ExxonMobil, Walmart, J&J, UNH, Bank of America, Chevron, Home Depot, Wells Fargo. So a lot of traditionally value stocks that have just been so deady spaghetti in the last couple of days. And again, just eyeballing it, looking at the stock history, in the last 4 years, this might be, I think it's the longest streak that we've had, with maybe an exception in 2021. But really significant devaluation in there, and super interesting stat. So thank you for showing us that.
Yes.
Hell yeah.
Sure. Also, for example, you just mentioned the Berkshire Hathaway forms part of the value stocks. This map actually shows the S&P 500 price to earnings ratio. 15 is considered standard. Anything above 30 is overvalued. Palantir, I actually highlighted Palantir. I may be a little bit biased because I'm short Palantir right now, but it has a price earnings ratio of 376. While Berkshire Hathaway, which you just mentioned, for example, for the value stocks, actually considered a little bit undervalued at 9 price earnings ratio. So I honestly thought it was an interesting heat map to show right now with the price earnings ratio overall, because as you said, right now with the possible corrections, the one we just got yesterday as well, which is very normal, and actually gives a little bit of possibility to enter maybe long. But it's at the end, when you see this very high valuation, especially with very high price earnings ratio, no surprise when you get days like yesterday, for example, maybe investors try to find whatever excuse they want to see to actually just sell the market, because on the next slide, we actually see the Fed projections. Basically, these projections is what caused a little bit of the spookiness. The other thing that I told you today might as well been also Jerome Powell's. He seemed a little bit nervous. I was watching the conference. he seemed a little bit not only nervous, but like he was not always the same Jerome Powell as we've seen him. But well, the economic projections showed a little bit of a bump in inflation expectations compared to the previous September projection meeting, just a mere 0.1% for inflation. Also, an uptick in GDP, which today GDP came for the third quarter and was above expectations, so pretty good for the U.S. economy. And also unemployment improvement. Both really good, GDP and unemployment improvement. But the thing is that investors were a little bit worried and maybe caused a lot of yesterday's reaction was seeing a little bit of an uptick inflation and basically Jerome Powell saying that current economic reports are actually not favoring inflation's downtrend like it used to be. So yeah, it was a pretty interesting forecast from the Fed that actually they publish every FOMC meeting up to 2027.
Very cool stats. Yeah, no, and it definitely showed today 60%. I'm looking over at the heat map on the Bad Trader platform. If any of you guys ever want to check that out, it's over on the trade page. 60% of the stocks in the S&P are actually down today. There are two sectors that actually did okay, and it's looking like financials and utilities. About 78% of utility companies in the S&P were actually green. But compared to yesterday, 94% of the stocks in the S&P were down. It's really only a handful that were actually up. It looks like energy is getting hit kind of hard today. 80% are down. And then, yeah, utilities and financial services are kind of doing okay. But evidently seeing a little bit of pessimism in the market these days, looking like a death by 1,000 paper cuts vibe after yesterday.
Last time I checked today, actually more stocks were actually up than down. I was surprised to see 60%. So the market breadth keeps on deteriorating.
I know. It flipped. Like the majority flipped, and that's a lot of companies. So you can all kind of see it getting tied to sort of the index, which is always a great sign. But really interesting stats. So thanks so much for putting this together. It was a really interesting stream, from earlier today. And yeah, looks like we got about 9 minutes left. You want to try to do a tradle?
Yeah, so let's see if we can get it. I think last time you got it on the first try, no?
Maybe not the last time. No, that's my heat map. If anybody, my heat map, Broadcom got donked today. So let me pull this up so y'all can see it.
It was Madagascar. I think it was with vanilla.
That one with the vanilla. The vanilla gave it away. Okay, everybody. If this is your first time playing Tradle with us, we like to play a game called Tradle, which is similar to Wordle, where instead we are given the export distribution of a country. We have to guess which country it is. So, for example, this country has $15 billion in exports. Not very big, and about half of that is petroleum gas. 11% is gold. We got copper ore. We got crude petroleum, nickel, mats. Palm oil, that's a good sign. Okay, palm oil, coconut oil. Okay, so we're dealing with something kind of tropical. And so basically what we got to do is we're going to give a guess. We're going to guess a location. And then it's going to basically tell us how far the target country is and what direction the target country is in. So this is small. We've seen it smaller, to be fair, but this is pretty small. And I'm thinking tropical. I'm also seeing like coffee in here. Coffee's in here. Actually, don't know what copra is. What's copra? Do you know? Is that a fruit?
No, me neither.
I have no clue, but vanilla, coffee. Okay, so I feel like we're dealing with something non-fillet frozen fish. Costco is the happiest place on earth. Sounds like we have some people at Costco or went to Costco today. But palm oil and coconut oil and stearic acid. Oh, this is the stearic acid, tiniest little sliver I've ever seen. But Luis, I don't think this is going to be easy. What do you think?
No. But I'm thinking something like in South America. I don't know what you... Maybe is there a?
It could be one of the
something can piggyback.
It could be one of the islands, and the islands, like when I was on with E last time, the geography of all the islands was a little bit tricky. The petroleum gas is throwing me. Half of it's petroleum gas, and then the palm oil, coconut oil makes me think it's like maybe something kind of tropical. Malaysia, we got a guess from Nan, not a number, Nan. We could you want to throw Malaysia in just to get a guess on the board?
Yeah, let's throw it.
Yeah, I don't think it's
to piggyback out of something.
I think Malaysia. Malaysia. I think Malaysia would have a lot more textiles, so I don't think it's Malaysia. Oh, it could be Venezuela actually. I think that's maybe a better guess. Venezuela.
Yeah, I was thinking like Ecuador or something on that line.
Try Ecuador.
Let's try with Malaysia, maybe, or.
I think Malaysia would have a lot more textiles. I just kind of want to get something on the map. Venezuela.
Let's go with yours first. Venezuela.
Venezuela? Well,
Then
that
we can
was
try Ecuador.
Emmett Morrison is making that guess. Venezuela.
Okay.
Let's see. We're going to make that guess. Ooh, it is nowhere near Venezuela. Okay, that's awesome. 17%. Okay, so it's about
So
as
it's
like...
not in South America.
It's definitely not. It's in Asia. It's got to be.
Philippines?
The Philippines was another guess. That was from VW Dieseldorf. We can give that a go.
Yeah.
Maybe Malaysia was a good guess. Oh, okay. It's a lot closer to the Philippines. And now we're really putting my geography knowledge to the test. So it's 3,200 kilometers away from the Philippines, and it's kind of southeast.
Let's try.
Now this is where geography, but we're 84% of the way there. So it's definitely a lot closer to the Philippines. It could, is it Malaysia?
Asia. Well, basically, now I might actually got it.
I think it might.
Let's try it.
Now I'm going to feel really bad for, why can't I spell today? Malaysia. Cannot spell today. Okay, it is not. It's right next to Malaysia, though.
Let's go.
It's next to Malaysia. Someone who knows geography much better than me. Big palm oil producers. Nan, I'm sorry for snuffing your guess. It was a very good guess, actually. It would have been a lot closer than my first guess. From Max, we're guessing Australia. Australia, I think, would be a lot bigger. It would be a lot bigger, and I think kind of more mining exports, like more mining stuff, like ores and metals. But let me think. Okay, so now I'm trying to think. Brunei. Well, I snubbed you once. I can't snub you again. You want to do Brunei?
Let's do it, yes.
Brunei. Okay. It's pretty close to Brunei. We got to go a lot more. We got 2 guesses left. We got to go a lot more east. Vietnam.
Vietnam, Indonesia. I was thinking like Indonesia, but I don't know if it's basically east and southeast of Philippines.
My thing, okay, so if it was, I feel like if it was Vietnam or Indonesia, it would be a lot more textiles because a lot of clothes are manufactured in Vietnam and Indonesia, right?
A lot of suede, no? I think.
15.4 billion. Try.
It's got to be big, a big country, because 15 billion is definitely big.
Okay, no? It's not that small. Yeah, it's decently big. You want to try? Yeah, let's try Vietnam. Try Vietnam.
Vietnam.
Okay. Man, my geography, my knowledge of geography in general is pretty terrible. We have moved further away.
Damn, this one is hard.
I know it's hard. We got one more left.
Southeast of Philippines.
Oh, wait a minute. I think it might be one of the Pacific Islands. Oh, it might be like Samoa or something.
Damn, I don't really know where Samoa is.
Kuwait is Middle East, other way. Iraq?
No.
Right?
Yeah, Iraq also, yeah, Middle East.
I think it's one of the Pacific Islands. I think it might be like Samoa or something.
I don't really know Pacific Islands. I think only Indonesia is the only one that I know, but I'm not pretty sure where is it located near to. I know it's near Philippines, but not necessarily if it's southeast. So I like your guess, Julia.
Oh God, yeah, my geography is pretty bad. New from Max. If you want to give a different guess, I don't think we're gonna get it. We got one guess. No, East Palau. You know, Emmett, I'm going to take a guess because I am really stuck on this one, and I'm going to feel like a real dingus when we get to, Luis, you want to pull it?
Let's do it. Palau.
Oh, that was actually... it's Papua New Guinea. God damn. You know, that's okay.
You actually said it, no?
Well, I didn't say Papua New Guinea.
VW
Dieseldorf just said New Guinea. That's so annoying. It's Papua New Guinea. God, I'm going to go look at a map after this. I feel like all my geography, that was like my worst subject. Geography and history did not click very well for me, and it shows. But a bunch of people at VW Dieseldorf, it sounds like, from the honor system, you got it. So well done. Man, but this was a hard one. Oof.
Yeah, it was a hard one.
It was a hard
because
one.
Because of Trello, it made me learn all of Africa's countries really good. Because I remember when you and I played, we always get an African country, but really need to study Asian ones.
Well, especially like when you're by like the Ivory Coast or whatever, like there's all those tiny little countries around there, like with Ghana, and so like, at this point, that's what I'm saying. With tradals are fun, but it's like at one point it becomes more of a geography problem. But VW Isidore, you'll take that. VW, very good job. But man, guys, well, I'm gonna go study up after this. I feel like I feel like I've failed. But what are you gonna do, Luis? I think we're just about out of time. Thank you so much for joining me today. Is there anything that you kind of want to tell people before we get out of here? Say anything?
No, Julia, thank you for having me here. The only ones that I'll definitely be eyeing for tomorrow, maybe longs, will be the Dow, because I think it's a good sign that finally ended up the day just a slightly green, a little bit. And also maybe the value, I don't know what you all think about it, but yeah, those are definitely my long positions for tomorrow.
Well, I don't know how I'm feeling. I'm just kind of holding on for dear life at this time. I think maybe a lot of us are. Yeah, Big Deal Donuts. I got to study up too. I got a Google Maps up right now, and I'm about to go see how far off American Samoa is. It's going to drive me crazy. No, you don't have to go. That's okay. We'll pull this down. That's for me. But you guys, it was an awesome time seeing everybody here. Thank you so much for coming. Luis and I are going to be back on Bad Trader actually not next Tuesday. Because it's
Thursday.
Christmas Eve, right? Well,
yep.
I hope everybody has great holidays. Happy Merry Christmas to everybody who celebrates it. And happy other holidays if you don't. It was awesome to see everybody here. Thank you guys again so much for joining us. I hope everybody has a green rest of the week, rest of the year, because I don't think, I'll be back sometime next week. But yeah, thank you again, everybody, for joining us, and we'll see y'all later. Peace.
Oh, yeah, it is Thursday, December 19th.
It came upon the midnight clear, that glorious song of old, from angels bending near the earth to touch their harps of gold. Peace on the earth, goodwill to men, from heaven's all gracious King. The world in solemn stillness lay to hear the angels sing. Still through the cloven skies they come, with peaceful wings unfurled. silent, silent, holy, silent, round thy head a radiant lovely boy with golden gown and parents guard thee with tender, tender sleep, thou darling one, sleep. Sleep, thou darling one, sleep.
People making lists, buying special gifts, taking time to be kind to one and all. It's that time of year when good friends are dear, and you wish you could give more than just presents from a store. Why don't you give love on Christmas Day? Oh, even the man who has everything would be so happy if you would bring him love on Christmas Day. No greater gift is there than love. People you don't know, smiling not hello. Everywhere there's an air of Christmas joy. It's that once a year when the world sits still, and you'd like to find a way to show the things that words can say. Why don't you give love on Christmas Day? Oh, the man on the street and the couple upstairs.